What's the biggest mistake investors make?
John, over here.
Oh, my mistake.
I invest on how I'm feeling that day. If I'm sad, I sell everything. I just do what everyone else is doing. I just asked my pet, hey Lola, should I buy more crypto?
Speaking of which, what is the biggest mistake investors make? Today, we've brought together a top group of investors to share some common mistakes, but also some practical solutions. It's all coming up in this week's Ticker Tape.
It's Ticker Tape, you know.
Hey John,
Hey Caroline.
what you got there?
Oh, this is my my basket of eggs.
Oh, you put all your eggs in one basket? That's one of the investment mistakes we're going to learn about today.
Yeah, we brought together a great group of seasoned investors who share their lessons learned over the years.
And so many times we do videos with stock picks from the pros, but in the long run, mistakes can be more valuable than just stock picks.
Absolutely.
Should we get to the list?
Let's do it. First, if you're not a subscriber to this channel, hit the subscribe button. And a friendly reminder,
This is not financial advice. Mistake number one, not having a plan.
Yeah, this might sound obvious, but it's an important observation from Christine Tan. She's a portfolio manager with SLGI Asset Management. She notes when you don't have a plan, sometimes people make emotional decisions, which is a no-no. Have a listen.
The most common investing mistake I've seen over the years, over and over, is allowing emotions to drive investing decisions. It's natural to feel fearful and nervous when markets are selling off. It's also natural to feel like you've missed out on something when markets are surging to all-time highs. But what's important is not allowing those emotions to drive investing decisions. The way to do that is to have a financial plan that's detailed, focused on the long term, and includes all your major milestones. Review that plan regularly and then stick to it. And if you can, invest regularly. So contribute regularly to investment portfolio. That will then allow you to dollar cost average and benefit from market volatility.
Mistake number two, trying to time the markets.
Yeah, this one comes from Brenda Juanas of UBS, and you've probably heard over the years, don't try to time the markets. One of the reasons for that is when you're trying to find the right wave to surf, it can cost you. Here's Brenda.
What I'm seeing a lot of in 2025 is investors thinking they can time the markets. And look, there's a lot of headline news. Markets are more volatile than they've been in years, but a natural inclination to sell your portfolio and find a better entry point, in my mind, is a mistake. As an example, if you had sold your equities before April 9th, you would have missed the biggest rally that we've seen since 2008. And also, from that week up until April 24th, the S&P is up 8%. So there are other ways to protect your portfolio, to be opportunistic, and I just don't think that timing the market really works in anyone's favor.
Mistake number three, panicking.
Well, this does have a little bit of overlap with what we heard from Brenda and Christine. It comes from Art Hogan, the veteran strategist with B. Riley Wealth Management. And Art notes that the problem with panicking is oftentimes it comes at the exact worst time. Here's Art.
It's a natural human instinct when there's uncertainty around things like tariffs and geopolitical events to get nervous about your investments. And typically, an investor that does that sells at the exact wrong point. A lot of the market action is typically pricing in future events. It tends to be a forward pricing mechanism. And by the time you get nervous and sell, you tend to sell at the worst time and miss out on some of the best activity in markets, which is rebounding off of some of the lows that have been made. And so I know it's always true that Wall Street climbs a wall of worry, but human instinct doesn't change. And you really, the best way to battle through that is to remember that you're in it for the long term. Stocks are a long-term investment vehicle, and volatility is the price you pay to get those higher returns in stocks than you do in bonds.
Mistake number four, too much concentration.
This one comes from John Petrides, portfolio manager with Tocqueville Asset Management, and there are really two related risks. One is the concentration risk, like having too many eggs in one basket. But beyond that, when you really need to make a change in your portfolio, when it's all concentrated in one place, that sometimes there's not enough liquidity faith in the market. Here's John.
The two common mistakes that I see investors making is one, not having enough access to liquidity within their portfolio, and two, being too concentrated within individual positions. I began my career 25 years ago at Bear Stearns Asset Management, and in 2008, when Bear Stearns went down, I saw too many friends and colleagues get ravaged by the sell-off because they couldn't sell their stock in time, and they had too much of their net worth in the stock of their employer that they worked for, Bear Stearns. So not only did they lose their job, they couldn't get access to their money, and a big proportion of their net worth was wiped out because Bear stock went down so much. So those are lessons that I learned that I pass on to our clients, is that make sure we have enough access to liquidity if you need for the rainy day fund, and make sure that we're not concentrated in any one individual position, sector, or asset class.
Mistake number 5, ignoring risk management.
This one comes from our longtime friend Mish Schneider of MarketGauge.com, and it's a really helpful example when you think about trying to manage your risk when you're making an actual trade. Here's Mish.
The key to thriving and surviving in this environment, in any market environment, is to understand risk management and position sizing. Our rule of thumb is basically, on any given trade, you do not risk more than 1 to 2% of your overall portfolio, and all in, max 15% of your portfolio. At that point, when that level gets hit, you liquidate, you hibernate, and then wait for the next opportunity. This way, you are insured psychologically to not feel hammered and ready to move in, making up that money easily in a trending market.
Mistake number 6, not using limit orders.
This is a second example from Art Hogan, who we heard from earlier. Limit orders allow you to figure out in advance what you want to buy or sell a stock for. In other words, the specific price. And in his opinion, if you're going to be buying individual stocks and you really want to make sure you buy or sell at a very specific price, limit orders can be quite helpful. Here's Art.
The market volatility around the open and during the day can certainly adversely affect the price that you think you're paying versus the price that you actually pay. So if you, in fact, want to go into the market and buy single stocks, make sure you use a limit order. You don't know what's going to happen and what kind of near-term volatility could actually change your entry price and your exit price. So use limit orders. Just avoid using that market order because it just doesn't always work out the way you intended.
Mistake number 7, discounting stock market history.
Yeah, this one comes from Jack Manley, a global market strategist at JP Morgan Asset Management. Now, Jack is a student of stock market history, and he notes that in bad times, investors often discount how good the stock market has been to a lot of investors over the long run.
Whenever there's a significant market pullback, one of the biggest mistakes I see investors make is to worry about how much worse things can get in the short term while forgetting that eventually things will inevitably get better. And take the S&P 500, for example. It peaked in February of this year at around 6,200. Now, ask yourself, is that the highest the index will ever be? Was February the pinnacle of conditions and things will never be that good again? If you're answering yes to those questions, then you're defying hundreds of years of market history. We know prices will eventually get back to those all-time highs, and while we don't know how long it will take, we do know that the return upside is significant. If, say, the S&P 500 is off 15% from its all-time high, any dollar put to work today will work extra hard. If it takes 1 year to recover, that's an 18% return. If it takes 2 years, that's almost 9% per year. These are numbers that should make any sort of future downturn a whole lot less intimidating for long-term investors.
Mistake number 8, forgetting about compounding.
Well, we've talked about compounding on this channel before. It can really impact your long-term performance. And so we wanted to add a third example from strategist Art Hogan, who explains why it can be harmful to your investing health to avoid compounding.
Compounding is one of the only free lunches that we get in the stock market. So if your account's not set up to reinvest your dividends, then you're missing out on a great opportunity. Not only will you continue to grow the size of your position, but then your position starts to pay for itself. Compounding basically means as you get paid dividends, you're taking that dividend, instead of taking that out in cash, you're reinvesting it in that equity that's paying you that dividend. And that is proven to be one of the most successful ways to invest long term. So when you look at the S&P 500 and its returns over the last 25 years, The price increase is one piece of the puzzle, but a very large piece of the puzzle in your total return is that dividend. And if you continue to reinvest that dividend, the reward for that is going to be a larger positioning and compounding. And compounding, again, probably is the one thing you forget about when you don't check that box that says, please reinvest my dividends.
And mistake number 9, being fearful of volatility.
Yeah, this final one comes from Philip Petursson, a great market thinker. He's the chief investment strategist at IG Wealth Management. We've seen a lot of volatility recently, but should you be fearful of that? Here's Philip.
One of the mistakes that we often see investors make is running away from volatility. And what we mean by that is during periods where we're in a market correction, where the S&P 500 is down more than 10% over a short period of time, investors tend to panic and sell and exit out of their mutual funds, whether it be equity funds or balanced funds or ETFs for that matter. We've seen this happen over and over again, whether it's the bottom of the market in 2009, bottom of the market in 2018, bottom of the market in 2020, or what we've seen just in the last few months. Investors at the sign of volatility, or when the market is down, instead of buying, they sell. Now, what we've seen is that there are periods of time that we're told by the market it is a good opportunity to get in. And one of the clear signs of this is when the VIX, the volatility index, breaks above 30. 87% of the time, going back to 1990, the inception of the VIX, we see a positive return for the S&P 500 1 year forward with an average gain of 22% when the VIX breaks above 30. It broke above 30 earlier this month, and that indicates to us that maybe rather than investors running away from the market, if they have cash on the sidelines that has been earmarked for equity investments, might be a good time to start thinking about putting that to work.
All right, that's our list of mistakes investors make. Our thanks to the market pros who participated in this video. You can learn more about them in the description. What do you think are some of the big mistakes investors make? Let us know in the comments. Thanks for watching. Thanks to Caroline Leslie. Be sure to check out her socials. And most importantly, don't forget to subscribe so you don't miss our next investing video. My mistake. See you next time.